Okay, let's get started. Welcome. As I say, the presentation is going to be in two parts, or two parts to today's webinar. We're going to discuss disciplined long-term investor, and the second part would be the 5 retirement myths that can spoil a happy retirement. So our ultimate goal as an investor is to have peace of mind with our investments and our retirement and things like that. But saying that retirement and your income in retirement is all about choices, and every decision has a ripple effect. So there'll be a lot of questions today around those decisions you make. So it's all about what are you willing to compromise on to make that master plan, your master investment plan work. Now, if you're about 5 years away from retirement, it's time for you to go through a thorough financial checkup, and obviously to go through the numbers, put it that way. And the question I can also ask today is, are you ahead or behind the game? And how realistic is that 5-year number? So remember, it's all that peace of mind. And we'll talk about in the next few slides, we talk about the problem. Most people don't have a good enough sense of how much it really requires to retire. So whether you've been spending decades or years and years planning for your retirement or your golden years, or you're just starting to become more serious about it, if you had to go talk to financial advisors, the first thing they'll do is examine all aspects of your financial picture. Now, I'm not a financial planner, so that's my disclaimer up front. So everything I'm talking in this presentation is for education purpose only. But imagine the financial planner is going to sit down with you, is going to ask you things about how much retirement savings you've got, about your estate planning, your insurance needs, and obviously your housing. All those kind of things comes into the picture. So the idea today is to, and I think that I always refer to Warren Buffett as someone I always look up to. Here's a quote from 4 quotes from Warren Buffett. This is regarding long-term investing. You only have to do a very few things right in your life, so long as you don't do too many things wrong. Okay, so that's some food for thought. Number 2, obviously, and I think this is one of his big secrets, he's a long-term investor. Our favorite holding period is forever. Okay. Only when you combine sound intellect with emotional discipline do you get rational behavior. And the 4th quote here from Warren Buffett, the secret of a long-term investment success is benign neglect. In other words, you're keeping an eye on it, so you're a bit kinder, but don't try to be too hard. Much success can be attributed to inactivity. So, and we'll talk about it a bit later when we talk about the long-term investing. So what is the problem? What is the current situation, position for a lot of people? Today, if you mention the word retirement, it sends to the average pre-retiree, his mind goes reeling. He's got a question like, will I have to work forever? Will I outlive my money? Okay, we talk about longevity just now, but that is a big problem for a lot of people. They're outliving their funds. Will I be a burden on my children as medical aid costs consume all my resources, all my funds? So those are just some of the questions if you had to ask a lot of people regarding retirement. That's what pops into mind. So most of the time, right before you retire, you're at the highest discretionary income in your life. I'm not there yet, but a lot of people, my age, the children are much older, and some of them have left their home already. My children still live with me, and they're still very young. But most people get into that stage now where children have left their house, and you might be in a situation where you've got 2 incomes coming in. So this is the stage where the highest discretionary incomes in your life at this point in time. So you're having lots of fun, having dinners out with your friends, you're going on holidays, you've got nice cars, life is grand. Okay, this is the current situation you might be finding yourself in. But the idea is that you want to be able to do this full time. So the challenge comes in when you go meet up with your financial advisor, and then the bad news knocks home. As I said just now, that we ask all those little questions. We find that we haven't saved up enough, or our nest egg is not big enough. And that's a problem for a lot of people. So, and this is where the questions come in. So, yeah, one of the biggest challenges, and this is a quote from Owen Arthur, in retirement is medical aid costs, healthcare costs. Apart from tax and medical aid costs, those are the things you have to worry about. But a quote from Owen Arthur, for he who has health has hope, and he who has hope has everything. So there's no use having all this money if you don't have the health. So obviously you want to be able to have the medical aid and the best hospital care in place. But that costs money. Okay, so what is the ideal position? So the idea is to build up a big enough nest egg or a big enough asset base that's going to give you enough income. And we'll talk about the different vehicles just now. And I mentioned this in about 2-3 weeks ago. We spoke about how much income you would need. For every 4,000 Rand a month in income, you need at least 1 million Rand in capital. So 4,000 Rand income, you need a million Rand asset base or nest egg. 8,000 Rand, 2 million, and so it goes on. So as I said, you need to build up that asset class first of all. The other thing you have to take in consideration is the tax. So obviously you build up an asset class, and then from there you can have income. The receiver taxes income. So you have to have a very important aspect is your tax. So you need a tax-efficient vehicle. So this is, and I'll speak about him just now again, Robert Kiyosaki. He always talks about your balance sheet. So on the one side, you've got your assets, on the other side, your liabilities. So yes, you've got rental property. And you might have shares, local shares, you might have an offshore portfolio, you might have a pension fund with your company, a provident fund, retirement annuities, endowments, unit trusts, you might have business interest. I have a lot of online business interest. You might have cash in the bank, interest-bearing securities. So these are just some ideas that you want to build up to form that nest egg. At this point in time, you must have your property. You must have a bond on your property. Remember, this is not I don't consider the house that you live in as a asset. If you've got, especially got a bond on it, to me, and Robert Kiyosaki talks about the same thing. Definition of an asset is something that puts money in your pocket. Liability is something that takes money out of your pocket. Okay, so I don't view my home I live in as an asset at this point in time as a liability. I'm not getting any income from it. You might still have some motor vehicles and car payments on that, credit cards, clothing accounts, revolving credit, overdrafts, loans. The idea is obviously to decrease your liabilities by the time you get to retirement age. You don't want to pay out of your assets, pay off your liabilities. So that's the balance sheet. Secondly, obviously, you want to set up what I call an income statement. So you got your income from all those investments. So you convert your pension and your provident and all that kind of stuff into a living annuity, and you'll draw a fund from that. But also you're going to draw from all these other different investments, as I say, endowments, your shares. Remember there we're talking about dividends, unit trust. We'll talk about unit trust just now, rental income, interest income, and obviously payments from your business interest. But it's also very important when we talk about expenses. Yeah, we talk about necessities. So necessities, as I say, I'm assuming by the time you get to retirement that your bond is paid off. So yes, we've taken care of shelter. So I've made that assumption already. You might have moved into a townhouse complex or a retirement home or whatever the case might be. There might be levies that you have to pay. But all of us need food. All of us would need medical aid. You have to take in consideration other insurance needs. You have to pay water and lights, rates and taxes, petrol and things like that. So those are some of the, I would say, necessities. But also, you're going to be in a situation where I want to plan for my holidays. Retirement is the days that you want to enjoy your life. So I might want to have 3 holidays a year. I still want to be able to have my country club membership, my golf club membership. I love my Jameson whiskey. I might upgrade from the normal traditional run-of-the-mill Jameson more to the 18-year-old whiskey. I like to eat more dinners more often with my friends. And also I might have a wish list. I always had the dream of sailing around the world. So maybe my sailing boat. On weekends I like to go make a noise around the neighborhood with my AC Cobra. But also things like personal development. I love courses and books and seminars. But that all costs money. So the idea is that yes, we've got the necessities on the one hand. Remember also, you need to take into consideration your cost of living is going up. So all these things regarding inflation, you have to make allowance for that. So now on the income side, as I say, you need to look at what's coming in. And then what you need to do is compare the two. Compare your income to your expenses. If the expenses are below your income, in other words, you've got a surplus, then go back to the beach and enjoy your margarita. However, if your expenses are above your income, we've got some work to do. Okay, we've got a shortfall. So we need to see what that difference is, and obviously we need to cut back on something. And that's what we're going to talk about now. And as I say, here's a quote from Robert Kiyosaki. Someone I really admire, is one of my favorite authors. I've read many, or most, well, I think I've read all his books by now. Quote from Robert Kiyosaki, and he's the author of Rich Dad, Poor Dad. The more money that goes into my asset column, the more my asset column grows. The more my assets grow, the more cash flow, income grows. And as long as I keep my expenses less than my cash flow from the assets, I will grow richer with more and more income from sources other than my physical labor. In other words, I'm creating more passive income. Okay, so it's all about cash flow. Okay, I hope that makes you, opens up some eyes and hopefully motivates you to get into that kind of situation. So where do we want to be? As I say, you want to be in a situation where you've got this cash flow coming in, number one, and number two, you've got a whole range of different investments that's going to give you that, as I always say, choice, and choice means opportunity, gives you that flexibility. And to me, having the time freedom and financial freedom, and that's what it's all about. Okay, to do what you want to, when you want to, how you want to, who you want to. That's where I think all of us want to be, and that's that peace of mind. Okay, so how do we get there? The idea here is, oops, sorry, I've gone too fast here. There's, call it 6 rules, and as I said just now, I'm not a financial planner. This is not advice. I actually got this idea I got from Forbes. If you click on this, here goes into more detail. But this is, I think it's what I like about this. It's a process that builds on the previous rule or previous step. So we've really spoken about having a long-term philosophy, but I'll go into it again. Now, there's 2 investment philosophies in the world. You can either believe that you have a high probability of beating the market. Okay, and I always say you want to be in a situation, you want to beat the market consistently, or you don't. So you fall into those 2 investment philosophies. If you believe that, and I've decided this a long time ago myself, that markets are more efficient at pricing as such, pricing securities, than I could ever hope to be. I don't have the skill to consistently add value to my portfolio by picking mispriced shares, number one, or the industry or the country, if I want to go offshore, or entire markets. So I've come to a stage where I'm happy being a long-term investor. I'm happy being between a value and a growth investor. But my whole idea is that, I believe that market returns is all I need. If I can outperform inflation, outperform the bond market by a healthy margin, I'm happy with that. That's my philosophy. Okay, but the idea is that I do have more of a longer-term investment philosophy. And we'll go into more detail just now. The whole idea is that, and this boils on to the second question, I believe it's more important to have a prudent asset allocation. We talk about asset allocation, it's just how your portfolio is diversified amongst different asset classes. Now, obviously, today's presentation is mainly on the equity side, okay, equity related. You can also talk about physical property. You can talk about cash and bonds, physical cash, and other interest-bearing securities. As I mentioned just now, business interests. And then what's important is to fit this asset allocation into your long-term financial goals. And it works on percentages. So, for example, I'm using, again, this is not advice, suggestion. Let's say, for example, you might put 50% of your funds, or 50% of you might be allocating to equities. You might allocate 15% of all your funds into property, physical property, rental property. You might like to keep 10% in cash, and that can be cash in the bank here, cash in dollars overseas, wherever the case might be, if you have an offshore account. And also business interest, maybe putting 25% of your money into different business interests and things like that as a suggestion. So it all works on fixed percentages that you stick to over a period of time. Okay, so the idea is that, instead of reacting to market turbulence, that you stick to your asset allocation. That's where it's important. What's also important, and this goes back to what I said just now, that one segment just on the equities, you want to select low-cost unit trust funds that represent asset classes in a different allocation. So that's one way also of diversifying the risk, spreading the risk. The idea here is that obviously you want to put into appropriate mix of unit trust funds that provides a broad diversification within that asset class. And we'll talk about it again just now. Maybe that's where you want to consider some of the PSG funds. And this is where it's important. And this is what I've learned over the long term. That, the market doesn't stay where it is. It moves up and down. And that's asset allocation you want to be able to handle through all market conditions. So we talk about rebalancing the portfolio. And especially when you come to your retirement, now you start withdrawing the funds out. You need to withdraw that all the time. And on an annual basis, and this is what most people do on an annual basis, they rebalance that portfolio because of the withdrawals, that income from your investments. So, but they still stick to your plan, talk it that way. Okay. And then what's also very important, do not change the asset allocation due to the market, to what's happening in the market. We saw at the beginning of the year, a lot of nervousness, a lot of volatility in the market, a lot of people got spooked, and they rush out and go sell things. Okay, no, you don't want to be doing that. Remember, your portfolio is based on your long-term needs. Okay, so it should maintain a long-term view. Okay, if you're prepared, if you're not willing to hold an asset or fund for at least 10 years, then you shouldn't own it. Anything longer, if you want anything less than that period, then you should be more in cash, call it that way. Okay, so the idea is that you want to build and hold your portfolio for the long term. And the sixth, call it rule that builds up in all of this is do not hold back. So yes, the market pulls back a bit. And a lot of us will say, well, the market's falling, I'm not going to contribute anymore. And this is what I found, rand cost averaging is powerful. So you're going to buy more units when the market falls, and obviously when the market recovers, you'll be buying less and less units. So I find it's easier to have a debit order in place, which makes it automatic. But also the idea here that you want to form good habits and then doing that consistently. Okay, so that's just as a quick outline into the six disciplined ways of investing. So what are we proposing today? Are we talking about, just today we're talking about the equity market. So you can look at the local share portfolio. Some of you might be looking at exchange traded funds as a separate portfolio, or you might have exchange traded funds as part of your normal share portfolio. And there's a core and a satellite approach. You might have a portfolio of offshore shares. The challenge with this, and this is what I've come to a conclusion, you have to get to the stage where you have to withdraw funds for income purposes. So either going to build up a large portfolio is going to give you dividends, or you have to start selling those shares off, and obviously that's going to trigger capital gains tax and things like that. So be aware of that. On the other side, and by the way, this is on the left-hand side here, this is a do-it-yourself approach, where you can give your money to a broker and he handles it for you. Yeah, we're talking about indirect approach for unit trusts, retirement annuities, but more importantly, I found this side, and this is what I've learned over the last few months, tax-efficient products. So retirement annuities, 27.5% that you can on your contributions deduct. Okay, tax-free investment savings plan, all those kind of tax-free savings plans. Use these tools, and those of you that are more worried about leaving a legacy and estate planning, is important to consider endowments. We spoke about this a week or so ago. Endowments, those of you who have family trust, consider endowments. And by the way, we'll be discussing that in next week's webinar. So these are some of the vehicles just on the equity side that you can use. So what will this do? And this we're going to talk about the myths okay, around long-term investing. So first of all, you have to ask yourself, what is a myth? A myth is a traditional story. If I had to use an example, the belief in Father Christmas when it comes to Christmas time is a healthy and long-standing and powerful tradition for many families, especially the children. Okay, things that also like the Tooth Fairy and things like the Easter Bunny. You know, it helps, creates fun in the family, and obviously creates it helps the child's imagination. Okay, but a myth can also be a widely held and false belief or idea. And when it comes to retirement, this is where a lot of people are getting misled. So let's talk about the first myth. And the first myth here is my expenses will be lower in retirement. We touched on it earlier. We talked about the income statement. Do you really expect your lifestyle to drastically change? And yeah, there's two sides of the coin of this, obviously, first of all. First of all, you'll get that scenario where, you know, inflation, your medical expenses we spoke about before, the cost of living might be a bit higher. So you have to take that into considerations. And also what's important is that you'll have more free time. So, you know, if you've got more free time, you usually spend more money, number one. And number two, you might be doing, you're pursuing hobbies that cost money. But besides your transport costs, okay, and your daily lunch money, what else you plan to cut back? So you need to take this all in consideration. But as I say, the cost of living might be higher. So you need to make sure that, you know, if you're going to withdraw 5% a month of your income, you must make sure that your portfolio is also growing more than that. Okay, so your expenses doesn't necessarily have to be lower. So, you know, be aware of that, number one. Number two, I will pay fewer taxes when I retire. You know, just because you have less income, okay, does not necessarily mean that you'll be taxed at a lower rate. So, you know, you have to look at what they call tax tables. Your income will be on tax tables. Depending on what you're using, you know, it's important to have this, consider especially tax when it comes to your retirement planning. And I've added, sorry, let me just go up here, just show you quickly. I've hidden the slide for you guys where we spoke about withdrawal funds on the lump sum. This is especially on our retirement annuities. Your first lump sum is 500,000, is tax free, but this one I refer to here, that income. So these are the tax tables. It depends how much income you're pulling out. Those who must be aware, you'll be paying 18, 27, and 36% tax. Okay, so be aware of that. So yeah, I just wanted to highlight it. It's hidden for you. But aware of that. Number three, I need to get out of shares when I retire. And I think this is where a lot of people go wrong. You know, yes, investing your retirement savings in the stock market has risks. Okay, but investing in shares, especially exposure to shares, will greatly provide long-term growth, especially beating inflation. And we're talking about in the next few slides, we talk about longevity. People are living longer into retirement. So it's important that you cater for that. Your retirement can span a few more years after retiring. So it's very important that you allocate a large portion of your funds to a diversified share portfolio, but especially take advantage of the equity side. Okay, number four, I would not be financially responsible for my parents or children. And this is where I've become to the conclusion that I don't want to fool myself. I'm part of the sandwich generation, if I had to put it that way. Whoops. Bring up my little curse here. I've learned that I'm sandwich generation. I'm the group of people that I have to take care of both my children and my parents. Okay. So I think a lot of you also will be falling into that category. So yeah, don't fool yourself. How are your children financially? Obviously, there's two people that are older, left home now, they're working for themselves. Number one. Number two, you might have elderly parents that are dependent on you. So yeah, take that into consideration. And the fifth myth, and this is I think where a lot of people I believe are falling short. People will continue to work late in life, do so because they're forced to, not necessary. Okay, they did a survey in the States where they found that a lot of people are living longer. But if you can, and this is where I'm speaking to a lot of financial advisors, delay your retirement as much as you can. Okay, They did a survey in the States, and they found that at least, well, some 61% of the workers indicated they liked to work. So they carried on working past retirement age. And they found that 40% of those people said those people felt valued, they felt they had a purpose, and they were contributing. A lot of people retire, they got nothing to do, they get bored, and their lifespan, they got nothing to work towards, and they die. Okay. But they found in the survey that a solid majority of these people, once retired, were generally satisfied with the situation. In other words, they had enough, they'd saved up, worked more to save up more. So they also found the retirement age or retirement time was the most rewarding time of their whole lives. In other words, they found that a very similar percentage found that they retired at the right time. People are living, and you'll see there's a quote. I was looking it up on Wikipedia. How many people actually live over the age of 100? In the United States, the greatest number, the United States has carried the greatest number of known centenarians of any nation, with 53,554 centenarians, 53,000 people living over 100 years old. Okay, that was based on the consensus in 2013. 82% of them were female. So that just made me realize, women need more financial education, and obviously the husband needs more estate planning and those kind of things to look after his wife. Okay, so those are just some of the myths, or 5 myths, that I want to cover today. So in considerations, you guys might be having a lot of questions and things like that, so I anticipate your questions. Remember, the whole idea, these different investment vehicles, and I want to highlight it for you guys again, is yes, you want to build up the income, but the idea is tax efficiency, number one, and obviously the income from that. Okay, so you might want to consider the PSG funds. We've got a whole range. We've got a South African portfolio, and we've got rand denominated, so you can go have exposure offshore. If you click on this little list at the bottom here, to take you to the A to Z list, there's more than 400 funds on our platform. So why would you want to consider PSG funds? Just from a cost point of view, I'll come back to that just now. Here we go, costs. So obviously the range of funds we've got on our platform, the support you've got, but also the costs, reduced costs. If you're buying into PSG funds, the ongoing platform fee is 0.2%. Okay, with that 0.28%. So very, very cheap and affordable. Let's talk about the PSG funds. And if you look at the longer term, our funds have outperformed. Okay, just obviously the last 2 years. And I spoke to the guys at PSG Asset Management, and they say, yes, they acknowledge their short-term performance lagged in 2015. Okay, they were early buyers of cyclical shares. They admit that. But their current positioning, and this is what I felt heartened by, the current positioning offers a compelling reason for buying. So those of you that are looking at some funds, as they consider PSG funds, the PSG Asset Management, they have an investment philosophy where they're looking for mispriced quality stocks. They have this what they call a 3M approach. And those of you who've been to the presentations before, we're talking about moat, management, and the margin of safety. But right now, a lot of these funds are offering attractive prices. The investment style, they're more value investors, as opposed to a lot of the other funds, which are more growth and momentum style funds. They remain confident. PSG Asset Management remain confident that the value-based investment philosophy and the process is the way to unlock the long-term success. So they're very optimistic about situations right now. So as I say, go look at the funds going forward. As a quote from Warren Buffett again, a very rich person should leave his kids enough to do anything, but not enough to do nothing. Okay, so that's also some food for thought regarding your legacy. So let's see what questions you guys have got. Okay, let me just maximize the screen quickly. Let me put back on my webcam. Okay. Sorry, let me just maximize my screen here quickly. The questions. Okay. Stella, everybody, Stella says she's got no voice, only a video. Internet problems. Okay, let me see what questions. Tony's got a good question here on I'm looking for medical industry ETFs. Unfortunately, here in South Africa, not specifically just on that sector. Offshore, I know there is, especially on the New York Stock Exchange and that kind of stuff. Biochemistry and all those kind of sectors. I have a question here from Graham. Is there an ideal percentage for each asset? There's no ideal. Everybody's Graham's asking, is there an ideal percentage for each asset allocation? There's no ideal. Depends on obviously your needs and things like that. Depends also on your style and your risk profile, Graham. So there's no ideal. So it's a difficult question to answer there. Ideal. Okay. Okay. Like those all questions coming through. Like a majority have had internet problems. Sorry to hear that. Some of you are fine and some of you are not. Steve, you don't mention Equinox? No, Equinox is part of PSG Wealth. So it's all on the same platform now, Steve. So, Tony Moore, buying and managing my own group of shares. I'm not 100% sure of your question here. I'm looking at for medical industry ETFs. That would mean, I presume, going on to medical ETFs. Yeah, it would mean obviously managing your own portfolio, having exposure to the first of all, opening up an offshore account and then buying into those ETFs that are exposed to the medical sector. As I say, here in South Africa, unless you go physically go look at all those different medical stocks, the Mediclins and the Aspens, all those kind of things. Okay. All the questions coming in now. Awesome. Okay, let me see what other questions I've got here. As a long-term question from Quibus. As a long-term investor in equities, which do you consider the best approach? Investing in companies paying high dividends or growth companies? Difficult question, and again, comes to your risk profile. Depends on your needs. Me personally, my mixture of my long-term portfolio is some value stocks, growth stocks, and also I have shares that are paying high dividends. So it's that mixture. So Quibus, the do-it-yourself approach, you have to manage that. You need to outperform the market. So you need to develop some approach. I like a fruit salad approach, value, growth, and high dividend yielding stocks. I hope that answers your question, Quibus. Okay, AJ, this is a question from AJ. Again, I'm not a financial planner. What is your recommended asset class mix for the ideal retirement portfolio? Yet obviously a large portion towards equities. To income to security or interest-bearing securities, as well as cash, a balanced portfolio, balanced unit trust portfolio. One way to look at it. Okay, so I hope that answers your question, AJ. Okay, Danny, it looks like I've answered your question. A question here from Maladi. What is the minimum investment on the different local products? Monthly and lump sum. What is the admin fee? Minimum investment on the different local products. When it comes to good question, Maladi. When it comes to equities, there's no minimum. This is if you do it yourself, building up a share portfolio. There's no minimum, but obviously you take in consideration the costs. Here at PSG Wealth, our minimum brokerage fee works on a sliding scale, 0.9% up to 25,000, with a minimum of 98 Rand per trade. So with 1,000 Rand, for example, your share has to move up 9.8% to break even. I suggest as a starting point, 10,000 Rand, then your cost as a percentage is 1%. So that's how you start building a portfolio. The admin fee on an equity portfolio is 40 Rand per month. On a unit trust, by the way, you can start with as little as 5 Rand a month debit order. However, the lump sum of the minimum is 20,000, which makes it economically viable. As I say, consider the platform fee on the PSG funds is only 0.2%, so it's very, very cheap. Andres, I'm not 100% sure of your question. What is the rule of thumb once net asset value or at retirement? And also at retirement, annual salary times retirement is 10. Not 100% sure on that question, Andres. Question here. Here's a comment from Colin, and I appreciate your a comment from Colin. It says Alexander Forbes also say that at retirement we still generate 40% of our savings after that time, like staying invested in shares, as I mentioned. Okay. For diverse strategy, how much offshore? Steve, quite a good question. There was a stage a few months ago where the guys were punting offshore exposure, rand weakness and things like that. And I mentioned before in previous webinars, do not invest offshore because of rand weakness. You want to diversify offshore for geopolitical reasons, whatever the case might be, but just take advantage of offshore. So, how much offshore? I like to diversify as much as I can offshore. I don't like to have all my eggs in one basket. It's a difficult question again. Our minimum requirement for offshore, going back to Malari's question, is at least 100,000. Convert that, divide that by 15 Rand to the dollar, doesn't mean a lot. So, as much as you can, your first million is tax, you don't need a tax clearance. Up to 10 million, obviously you do need some tax clearance, but take as much as you can offshore. If you don't want to take advantage of your offshore allowance, you also got the asset swap facility. And there's no limitations on there. But have exposure to offshore. I believe there's a lot of opportunities in the US, there's a lot of opportunities in the UK. Yes, the UK market has come off a lot to do with the Brexit, but there's opportunities, especially in Europe. But put your money in other baskets too. So, Steve, I hope that answers your question. Okay. That looks like all the questions that come through. Cool. Okay. So, guys, just quickly, we just minimize this again. Take it out of the way, rather. Questions? So, in conclusion, okay, what I want you to remember from this presentation, those 6 rules. So, go review those rules again. Remember, it just builds on the previous slides. Those 5 myths, a lot of you guys would have been aware of it, but in reality, obviously, there's a lot of other things you have to take consideration. Those investment choices, those different investment vehicles, you want to build up an asset base. Those are some of the suggestions you want to look at. And then obviously consider our PSG funds. So what to do next? Next action steps. For more information on what PSG offers, you can go click on this little link to take you through to all those different products I was talking about early on. If you've got any further questions, you're welcome to contact our client service department or the phone numbers. Okay. But from my side, I appreciate you guys taking out the time. Your busy schedule to be here today. Next week, as I say, we're talking about family trusts and how to use that as a vehicle. And there's a lot of changes happening on that side. On the 25th of May, we're talking more fundamentals. So we talk about I talk about the magnificent seven shares that we think might be offering opportunities. Those of you who are more the long-term equity investors. So, and as I say, we're focusing on more the fundamentals that day. In June, we talk about very much what we spoke about today. When is enough is enough? When will you have enough for retirement? Yeah, in the middle of June or 8th of June, we're talking about currency futures, single stock futures thereafter, Aussie trading and things like that. Okay, so that's our upcoming webinars. Our seminars look like we're moving to biannual at this point in time. So we're looking at the end of June or middle of June rather, and it'll be around the country. So we may be Joburg, Durban, and Cape Town, and we'll see how it goes from there. Okay, but guys, from my side, again, thanks for being on this webinar. There's my contact details, our email address, there's our switchboard number, toll-free number. I hope you found benefit or found something out of this webinar today presentation. As I say, I will be sending this to you guys. But from my side, enjoy the rest of your day. And again, there's my disclaimer. This is all, remember, it's for education purposes. No advice should be taken here as literal. Education purposes only. Okay. But thanks a lot for being on this webinar. Until next week, all the best. Bye for now.